Equity markets rebounded in October, recovering close to levels in August, immediately prior to the falls associated with concerns over growth in China. The recovery in equities was driven by easing of concerns over the probability for a hard landing in China, as Chinese economic releases began to show some signs of stabilisation, an improvement in developed market economic releases in early November, and indications from the ECB that it will increase the level of monetary stimulus in December. Bond markets have been more volatile over the last 2 weeks, with German 10-year yields initially falling to 0.42% on expectations of additional ECB asset purchases, only to rise to 0.65% currently on increased expectations that the US Fed will raise interest rates for the first time in the current cycle in December. Following the surprise Chinese currency devaluation in August, fears grew regarding a possible hard landing in China, with concerns over potential contagion to the global economy causing equity markets to fall. Recent economic data in China, however, has shown signs of stabilisation, with retail sales growth improving marginally to 11% year-on-year, property prices rising for 5 consecutive months, lending returning to modest positive levels of growth, and key PMI sentiment surveys either stabilising or showing some slight modest improvement. In other key Asian markets, industrial production improved to a 4% annualised growth rate, while global PMIs also rebounded, with manufacturing readings rising to their best levels since April, following inventory drawdowns during the summer months. Most notably in the US, following some softer economic data in October, the non-farm payrolls release in early November, detailing the number of monthly jobs created, was significantly stronger than expected at 271,000, with unemployment falling to 5%, indicating the labour market and underlying economy remain well underpinned. In Europe, despite some weaker German data in recent months, sentiment surveys suggest growth in the Eurozone is running close to 2%. Overall, while global growth is likely to remain modest and below levels evident pre the financial crisis, the global economy seems set to maintain a steady low growth trend in the region of 2.5% to 3%, which should remain supportive of equities in terms of facilitating global earnings growth in the region of mid to high single digits. Having passed at raising interest rates in September due to concerns over potential threats to the US economy from slower growth in emerging markets, the US Fed has now indicated it is considering raising rates in December. In its most recent post-meeting statement, the Fed was much more confident and upbeat about the outlook for the US economy, omitting any previous references to concerns about global economic and financial developments which could negatively impact the US. Instead, it spoke of solid trends in consumption and business investment and of diminished underutilisation of labour resources. Following the recent strong non-farm payroll release, the market is now assigning a 66% probability to a December US interest rate rise, and this increased confidence in the strength of the US economy has been reflected in the rebound in the equity market. In Europe, at its last policy meeting, the ECB suggested that the degree of monetary accommodation being provided will need to be re-examined at the December meeting, as inflation appears increasingly unlikely to rise to the ECB's 2% target. The ECB indicated all policy options are being considered, including changing the size, composition and duration of the current €60 billion per month asset purchase programme, and also possibly reducing further the already negative deposit rate of -0.2%. The potential for additional monetary stimulus from the ECB also contributed to the rebound in equities and should continue to do so when announced in early December. Despite global equity valuations moving back close to fair value on a PE basis, we believe equity markets can continue to move slowly higher. With tail risks and fears over a Chinese and global economy slowdown being removed, Equities can benefit from continued modest global growth and positive earnings growth. Continued accommodative global monetary policies should be supportive of equities, with additional stimulus expected from the ECB and only slow, gradual interest rate rises expected in both the US and UK. Equities remain extremely attractive relative to bonds and cash, given the low yields available on these assets. Returns to investors in euro terms from international assets have been boosted by the weakness in the euro, which has fallen to 107 against the US dollar. With monetary policy paths between the Fed and ECB likely to continue to diverge, further euro weakness to around parity against the US dollar is possible.